Hello and welcome. My name is Joe O'Mara. I am the Head of Aviation Finance with KPMG. On behalf of KPMG and Airline Economics, I'm delighted to be joined by Ryan McKenna. Ryan is the CEO of Griffin Global Asset Management, and he's here to join us for the purposes of our Leaders Report that will be coming out in January. Ryan, before we get into the meat of the conversation, perhaps you'd tell our watchers a little bit about Griffin.
Sure, Joe, thank you so much for having me, and Victoria as well. Griffin Global Asset Management was formed in January 2020, and we formed a joint venture and a general partnership with Bain Capital. And we set out to build an alternative asset management platform, of which one significant vertical will be aircraft leasing. Over the last, I guess now, nearly 3 years, we have pivoted entirely up credit in aircraft leasing and have done a little bit over $3 billion of new aircraft deliveries, so brand new deliveries from Boeing and Airbus. We have made an investment in the new flag carrier of the Dominican Republic, so our first operating investment, to capitalize that startup airline, which now has its first 5 MAXs in service, and we'll keep growing in different verticals as we grow the business.
Yeah. And I'm going to be really interested to touch on some of those verticals, particularly the RJet piece in a few minutes. Maybe level setting to begin with, right? You guys obviously came in with a clean balance sheet, kind of post-crisis. In your view, where does the recovery sit currently? And from an opportunities perspective, kind of what geographies are you targeting?
We certainly came in with very, very fortunate timing, and I would put that in the category, as I said last year, it's better to be lucky than good, starting a firm in January 2020 without any legacy assets or issues to deal with. So we started with fresh capital and have tried to be thoughtful in how we deploy it. We are not traders per se. Like, I have never been oriented around trying to be smarter than a market with bottom ticking or top ticking valuation or rates, et cetera. We really have looked to deploy capital to long-term partners that we think will win over many years, that are not sort of timing related type trades. With regards to your question of where we are in the recovery, I think of this as sort of that bullwhip analogy, where there was major distortions created by the global shutdown post-COVID, or right when COVID happened, where people were sidelined. There was then an enormous amount of fiscal and monetary stimulus to sort of re-energize an economy that put a ton of capital in people's pockets in the form of valuation, in the form of direct stimulus that was given to people. There was certainly pent-up demand for people wanting to get back and travel, and it feels like we're now in the middle of that sort of other side of that whip, converging back to what will be a new normal as cost of capital has increased dramatically, inflation has taken over globally, and when do people and consumers think twice about their desire to fly or desire to spend more broadly. So my perspective is we're in the early innings still of what it takes to get back to a sort of normal, we're going to grow 2, 3, 4% a year. So we remain very cautious in trying to find businesses and people to support that really are going to survive through the significant challenges that I still think exist.
But if you think, is there a through line on the opportunities you have pursued over the last couple of years? You talk about deploying that $3 billion. Is there a theme on the airlines you've engaged with, or as you say, are you just making an assessment on a kind of point in time?
No, there is definitely a theme to it. So we have certainly taken, our view is that if you survive the pandemic by levering up or by taking on additional capital, that it really is just a question of time rather than if you will need to restructure. It's very, very difficult to be cost competitive with carriers that have already gone through those processes to fundamentally change cost structures. And what I mean by that is whether it's labor and changing sort of those union contracts, whether it is fleet and changing sort of what airplanes you fly and what routes you fly, or amount of debt outstanding. I think it's very, very difficult to envision a world where there's such great profitability at carriers that they can simply de-lever naturally in the face of what is very stiff competition for those that have gone through that process. Additionally, the sort of low-cost and ultra-low-cost models, I think, were structurally set up to be advantaged in this type of an environment. We also are big believers in newly capitalized businesses, so not just RJet, but others that have really strong backers and scale, from capital as well as the OEMs to succeed. I'd say those categories, and maybe the fourth being state-backed carriers, and not all state-backed carriers are made the same, as we've seen certain bankruptcies even with sort of state backing. I think that requires particularly nuanced analysis with which carrier is truly too big to fail. But those are the categories that we've spent a lot of time supporting.
And you touched on some of the challenges that are there from the macro environment, both geopolitical and from an economic perspective. How challenging is that making medium-term planning, right? So we have inflation like we haven't seen in mine or your lifetime. We have oil volatile and higher than it was, and interest rates particularly, right? So how challenging is that when you plan on, you've been relatively aggressive in deploying capital, as you say, in a targeted way, but how challenging is the macro environment making medium-term planning?
Well, I think it's very, and I'd add one more category, which is currency. So those three plus currency to me are ever-present issues that need to be thought through. And I think people in general, our industry, I think, has this incredible spirit of this too shall pass. Like, we can get through anything, because what hasn't been thrown at the global commercial aviation market over the decades. I think this is going to be particularly challenging. I think it's wonderful to have had a summer of really high passenger demand and incredible prices that have gone with that. So the pricing data has been remarkable. I just am not so confident that that sustains. And so medium-term planning, again, I think you have to have long-term planning. Like, I don't think we're in for a trade, I guess is my original commentary. Like, there's not something that I say, oh, well, at this price we're good and we want to deploy here. Like, we really do fundamental analysis on whether that carrier is going to be able to survive what we think are continued challenges. And you've mentioned oil, you mentioned interest rates, which are very, very clearly elevated and for much longer than I think a lot of people were willing to admit 6 months ago. And still the demand side is unclear. Consumers remain incredibly strong now, but how long? I think that's a significant question. I think the connectivity globally has changed post-COVID, where you can fly and where you can't fly. Certainly Russia in the middle of that conflict provides a lot of challenges for certain routes that once were possible to fly that no longer are possible to fly. So my perspective is there's challenge everywhere. And so while yes, we're willing to deploy in size, I think we're going to be very specific in who we're backing and making sure that those business models have an ability to outcompete relative to their sort of market and their demand picture over the coming multiple years. So it's a midterm, not a near-term look, mid to long term.
Yeah, and maybe keeping with that interest rate theme piece, just the challenges in pricing at the moment, right? We're obviously in a very volatile piece, and I should say we're recording this at the end of October. The challenges on that from a pricing perspective, so trying to understand a little bit around, what's that doing to lease rate factors, what's it doing to relative value? Obviously you upsized the warehouse quite recently, right? Do you want to talk to me a little bit on the funding challenges and pricing challenges that are coming with this interest rate environment?
Well, I think you highlighted all of them in the nature of the question. I think that cost of capital writ large has gone up. And there's less capital available. So both in credit and equity, I think there is less than there has been. And so that's number one. So supply has reduced. I think the cost of all of that capital, as I mentioned, has gone up, both in the form of credit and equity costs. And there's a lag effect of, like, how long does it take for business models to adjust to that? Because you cannot simply just pass that along. I mean, I would love to say we're in an environment where you can raise 3% cost of debt like you could for the better part of the last decade, but US Treasuries are higher than that right now. So that's not really a realistic piece of the inputs, as I think carriers focus on how they price their actual ultimate service. So again, I don't start from the cost of capital, I start from what the businesses can actually do and what the sort of elasticity of demand they have in their given markets. And from there, then it becomes a pricing dynamic. I would say that as we sit here today, there are fewer people bidding on different transactions than there would have been in the past, although we never have been particularly successful at RFPs. But they're important to understand, like, where market clearing prices are. There's no question that lease rates have gone up, lease rate factors have gone up, as have prices for assets, because I think the inflation piece of it at the front end is non-trivial. Escalation and inflation from the OEM deliveries is absolutely a real thing. Those are formulas that were agreed to, in some cases 10 years ago. in other cases 2 years ago, but nonetheless, all of them have price increases at the front end of that curve of what the planes are worth. I would assume over time that whole curve shifts outward to go with it, but that takes time to adjust. So all of these things are really difficult to sort of isolate and say which factor is the one in any of those pricing analysis, but they all have to go into that calculus about where we think makes sense to support and deploy.
Not a market that you've played in yet with Griffin, but one you would be very familiar with in your former life is capital markets ABS. And more to get your general thoughts on it. I know it's probably not one you're keen to tap in any immediate piece, but your thoughts on where that market sits in this heightened interest rate environment. You know, it has been such an important channel on the secondary trading market. You know, it coming back will be important. Just your thoughts around, as I say, in your former life, you would have been heavily involved in it.
It's a market that is near and dear to my heart, as you well know, and so I appreciate that. Look, I think I might have said this to you guys last year, I do believe it is different this time. What I mean by different this time is I don't think there's any fundamental problem with the ABS structures. You look back 10 years ago, there were underlying flaws with the ABS structures that had the interests of bondholders at odds with equity holders and with managers. And I think a lot of those alignment issues were resolved in the middle part of the 2010s that made the product work. The issue right now is actually, I don't think the market is closed. I think that buyers and sellers are not willing to meet at the clearing levels of where the market currently would trade. So I'm not trying to say one side is right or wrong, but I think that a lot of the issuers are in a challenging position because they have yesterday's assets, meaning they have lease rates and purchase prices that were struck multiple years ago in one interest rate environment and probably went through some non-trivial restructuring, amending and extending during COVID, which also would have impacted what you're generating on returns-wise, and now have a very, very different environment for the liabilities. And so that is a particularly difficult square to circle, so to speak. So I think for assets that are performing or assets that have cash flows, I think the ABS market would be completely functioning in today's environment. I think you could get deals done. I think the problem is that there aren't the issuers with assets that make sense to get done at where the current cost of credit is pricing. And your guess is as good as mine as to where that sort of starts to rationalize, but you'd have to think that sooner rather than later, large platforms have to start issuing in the capital markets, have to start issuing, unsecured bonds, have to issue secured bonds, deliveries keep coming, and then at some point you need to refi existing pieces of paper. So I think it's a little bit of a waiting game right now, and a lot of the issuers, I think, have been hoping that rates would come back and be more favorable. At this point, it's difficult to see that anytime in the near term.
Yeah, and I think that's it. We just feel as if we're in that sense of stasis at the minute, right?
Yeah.
A stall in the market. And obviously, if ABS isn't there at the moment, it puts an increased importance, I guess, on the other options, right? So your thoughts, and I mentioned the warehouse a little bit, your thoughts on maybe the traditional lending market, and also your thoughts a little bit around the non-traditional lenders. So the ones we've seen come in, looking at lending platforms specific to aviation, but not your typical banks. Just your thoughts on how that market is developing.
Yeah, I don't really think that market is very deep. I think the banks are the market for that lending piece of it. I think there's always going to be a role for sort of specialty lending for custom circumstances, but I think broadly speaking, the banks are extremely healthy and have capacity for the right types of loans. There was obviously a window during COVID where everybody was kind of seized up trying to understand where the world would go, but that passed very, very quickly. So my perspective is that the banks are really good at doing what they do, and again, I'm not calling what spread or what base rate they're doing it off of and what the fees are, but I think they're very good at serving the needs of global aircraft leasing platforms and airlines. So I still think that is where the vast majority, if not virtually all of the lending will continue to exist. What was the second part? Was on opening the markets?
So that non-traditional lending piece,
okay.
but I think you answered me there when you talked about that not a very deep market yet, right? Curious if we might see more players come in there, and it might be a leg for. We've probably seen a couple of the larger private equity asset managers move into that a little bit, right?
And again, I think I've never really gotten my arms around that market because you're dealing with the competition for that is deposit taking lenders that will always structurally have a lower cost of capital than especially finance business that has to have some source of equity that is not a deposit. So from my perspective, that cost of capital always is going to be higher, and really the time when that works is when the banks have some issue that means they're sidelined, and I don't see that in the near term. So clearly there was a window where that might have happened during COVID, but I think over the long term, we have big issues economically if banks are not able to function I'm not going to call what LTV, and I'm not going to call again what the spread is or what upfront fees look like, but I don't see a structural problem with lending from the money center banks or even global banks.
And on the investor side, so you mentioned obviously you guys have been extremely well backed by Bain. We've seen that private equity has always had a love for aviation, and that's probably increased right post-COVID. Your outlook on the investor side, and have we seen any evolution or themes coming with the types of investors coming to aviation finance post-COVID?
I'm not sure I see much of a difference. We're not oriented again on trading, so like there wasn't a timing trade for us to come in, and in every single one of the different deals, many of which that haven't closed or that we haven't won versus ones that we have prevailed in with the broader Bain Capital team, we really haven't been looking at timing trades. So this really wasn't you're pouring in because there looks to be a distress situation in COVID. We started dumb luck in January of 2020. That doesn't mean we won't buy things that are in bankruptcy, right? I mean, the Bain team obviously acquired Virgin Australia out of the bankruptcy process. So that's part of what you do, but I think it's really looking at long-term compounding value, right? It's looking at exiting with multiples of money as opposed to, the markets have traded this off, let's buy low and sell high. I think it's about really growing businesses. So that's how we're oriented. And so haven't really engaged in a lot of those, like, is there something cheap to go buy? It's like, does it work for a long period of time is really what we're thinking about. So in the broader question, has more or less shown up? I mean, I think there's been plenty of people who show up opportunistically to see if they can, access opportunities. I would say that scale is meaningful insofar as accessing capital to support it. And I think it's very difficult to sort of be good in this space if you're doing 2, 3, 4, 5, 6 airplanes and then trying to go there. And I certainly would not claim that we are the largest scale. There's plenty of others that are much, much bigger. But deep access to capital and billions of dollars of capital, I think, are somewhat the requirement to be at the table for a lot of these things, or it's just a trade, right? So there's one thing to trade versus another thing to build a business around it. And I think you'll always have private equity firms or funds looking to make a trade, but I don't think there's much difference in those who are trying to build sustainable businesses versus trading now versus pre-pandemic.
And taking maybe aircraft as an asset class, right? And I'm not sure if you have perspectives on this from a Bain, who obviously have such a broad breadth of investments that they'd have, but your perspective on aviation generally as an asset class and how it stacks up to other opportunities that investors might be looking at. We've seen a general sophistication or maturing of the market clearly over the last decade plus. Your thoughts on where it sits now, and is there a little risk in this heightened uncertainty that it becomes slightly less attractive?
To answer the last part, no. But I think there's pricing dynamics that make it more or less attractive depending upon what you're looking at. I think that the last decade there was a real professionalization of financing aircraft airlines. I think you saw a lot of breadth of products in the credit markets, breadth of equity products show up, and a lot more people get engaged than what probably it looked like, predating us, candidly, like in the 90s or the early 2000s, about who was buying and selling and trading at these conferences. So I think the business broadly was professionalized, and I think better transparency and better disclosure and reporting, more parties involved. I think all of that is very good. I don't, again, think of it as relative value today or yesterday or 2 days from now. I think global aviation and commercial traffic is going to be essential going forward. Exactly what the growth rate is, or exactly when there's shrinking demand versus growing demand, that's impossible to call. But I still think there's the fundamental demand to travel, and the thesis that we had in starting Griffin was we're willing to support lots of parts of that ecosystem, right? It may be airplanes, it may be airlines, it may be maintenance, it may be engines, it may be manufacturing or infrastructure. Like, I'm agnostic as to what the actual product is. It's to support a business that's going to grow over many, many years, and can we provide capital solutions to be partners with them? So again, timing, cost of capital are important at any moment, but it isn't sort of what I think fundamentally makes the investment work or not work.
And maybe keeping with the vertical leasing for a moment, then we've seen a clear shift in the popularity of leasing post-COVID. The reasons are clear around balance sheet distress. We've breached that 50% threshold, and if you look over the long-term average, it only ticks one way, sometimes quicker than others. Your thoughts on, one, is the shift beyond 50% now sustainable, and two, if yes, will it go higher?
I'm going to punt. I don't know and I don't know. Those types of macro trends are very difficult for me to call. You look at, when you think about cost of capital and relative value, there was, through the last decade, capital was certainly more expensive and scarcer, or more scarce post the financial crisis. And over that decade, access to capital improved broadly and sort of becoming less expensive for equity, less expensive for unsecured, less expensive for secured. And the terms that sort of lessors were willing to take, airlines were certainly in the driver's seat of loosening terms in leases. Much the same way that lessors and borrowers were in the driver's seat of loosening terms from banks, because there was really that just more demand of people looking to put bank debt to work, or more demand in the capital markets to work, or more demand from the airlines. That seems to have changed a bit. And while I am not one to have ever said, oh, there's silly money here or silly money there, because there's always reasons that someone is looking to put it to work for whatever their strategy is or whatever their region is, it does feel a little bit like there's a shifting of capital going on. It seems like the sort of ever-present Chinese capital that was coming into the market seems to have either paused or slowed a bit. Certainly not for large, well-established players. They're obviously involved, but some of the smaller players, it feels like that may have shifted a little bit. It feels a little bit like, because of currency, some of the traditional funding markets like Japan have slowed and will have to slow more. It's very difficult to buy dollar-denominated assets when your currency has traded off 30+%. Even if there's a tax arb, like, there's such a big move in currency that if that strengthens, you're in really, really big trouble. So I think there's a lot of different challenges that most people who have been investing or deploying capital in the space are now dealing with in a different way than they would have over the last decade. So I don't think there's any less desirability. I mean, fundamentally, people still want to travel, but how that is manifest and where the capital is coming from, what the underwriting terms look like or what the clearing terms are, I still think we're in the find that right now. Like, that's kind of live in process to figure out who's going to raise capital at what prices and what markets will be open and who's available. So that's very, very relevant for the moment we're in.
Yeah, and it speaks to maybe a point you were making earlier on scale, right, and the importance of scale. And your thoughts on, has the importance of scale increased? You kind of look at the leasing market and we saw a large diversification over the last 10 or 15 years, more lessors, more players in the game. Do you think that's going to tighten, right? Is it the fact that accessing capital, be an IG-rated lessor or someone who has a very strong parent behind them? If you don't have that now, are you at risk?
Yeah, certainly in today's market, you have more challenges, and probably in every market, you still have more challenges. I think there's been no question that the leasing platforms that have been backed by large financial parents or the investment grade, which maybe both, they may overlap, but they have absolutely had an advantage in the cost of credit over the past decade. There's no doubt about that. It's an interesting point in time now because maybe some players who could have gotten bank debt before may not have as much access to it because of that scale. I'm not obsessed with scale. This isn't like you have to get big to succeed.
So it helps.
But there certainly is help, and it's a testament to all those platforms at scale that managed to perform so well on a credit perspective, and the rating agencies I think have acknowledged that by holding ratings relatively unchanged, even through the incredible dislocation that commercial aerospace has dealt with through COVID. So I'm not obsessed with scale. Clearly, you have to be big enough to be able to deploy capital in meaningful ways and raise capital. But right now, it's very difficult for small guys to raise money.
Yeah, and it does mean, I guess, people are looking for different types of opportunities. And you mentioned verticals, right? So it'd be keen for you to talk us a little bit through what you've done with RJet, the thinking behind that play, and maybe, I guess, the different skill sets that have been required in supporting that startup business versus, sale and leaseback business, something you're very, very familiar with.
It has been, it's like being thrown in the deep end, is learning how an operating business works. I have the utmost respect for airline executives and the different challenges they have. Certainly the financing side has lots of complexity, and there's many, many smart people who are involved in what I have traditionally done. It is a completely different skill set in helping to support the growth and establishment of an operating business in a new airline. First and foremost, you back people, and you back the individuals who are leading them. And that was front and center in our decision to back Victor Pacheco in his dream to build the flag carrier of the Dominican Republic. The investment was, again, not a timing trade. It was a fundamental demand that there's an island in the Caribbean with 11 million people, with 2.5 million Dominican diaspora in the US, that didn't have affordable access to airfare. And so it's a country with a certain sort of GDP per capita, there's a certain amount of disposable income, and we felt that there was a fundamental demand, as did he and as did the president and the government of the Dominican Republic, that there needed to be a more cost-effective way to bring, first and foremost, Dominicans home for holidays, to visit family, and to travel off the island, and then second, in sort of tourism and leisure, to give better and broader access around Latin America and eventually to the US, to the beautiful beaches and holiday destinations in the Dominican, and eventually, I think, connectivity around the Caribbean and around Latin America and North America. So we view this as a business that will grow for the next decade as they grow into the order that they placed with the Boeing company for 20 firm and 15 option maxes. They've already closed their first sort of additional bridge aircraft from another major leasing platform, and we'll probably add aircraft over time. But the skills involved in dealing with the regulators and getting an operating certificate and putting a maintenance plan in place and all the procedures around safety, processes and bottlenecks of how to actually sell tickets and manage a ticketing inventory system and revenue management, how to deal with maintenance programs, hiring practices, people. It is so different than what I did for the prior decade, and I feel so fortunate to be a part of it and on the board and to play a small role in supporting their success. They're an amazing group, and they've got an amazing opportunity with this sort of I view partnership between the Boeing company, between the government and real demand in that country, and then backed by a bunch of capital from Bain and Griffin.
Yeah, so a deepening respect for your wider client base.
Hugely respectful. So I have new respect for how difficult it is to build a successful airline.
And maybe keeping with fleet for a second, right? So you guys have put in an order, right? Curious as to the thinking behind that. 5, if I'm not mistaken.
We have a PA with Boeing, and the first 5 were there. It was part of sort of those going eventually to RJet. We've used that PA to add other delivery slots too that we don't really disclose who and why, but we've moved sort of different positions on there as part of facilitating PDPs and then also to the ultimate delivery. I would say that orders are great. We probably will never be a giant orderer of aircraft, but is there a role for some amount of orders as we continue to scale the platform? Sure. I see us doing plus or minus $3 billion a year of aircraft financing. And at some point, could an order be a part of that? Sure. At this point, it's hard to imagine that making much sense. Not from our perspective, but really from the OEM's perspective. Like, we seek to be a partner and support what they're doing. And I would assume that when you've interviewed your sort of the folks from Boeing and Airbus, they would say they're sold out to infinity and beyond at this point. So I'm not looking to try to make I'm smarter than, I've got a real insight into 20, 30 delivery positions. I have no clue. So that isn't really what we focus on, because I just don't think we can help make a difference there. Whereas I think there are a lot of different places right now that, people need help with delivering the scale of airplanes, or with special structures, or growth in different ways, whether it's equity or preferred, or different structured pieces that they need in their business, or growing, their terminals or their infrastructure, that we'd support in any of those diversified ways.
But that fleet focus piece, because some of the sale and leaseback stuff has obviously been Airbus as well. It's been a predominant, presumably narrow body new tech focus to date.
It's both wide body and narrow body. So I think the number is now we're reaching 50 new deliveries that we've committed to, and I don't know what we'll end the year at, but somewhere in the 30s, depending upon delays and what actually is delivered. But no, we've done a handful of different wide bodies. We've done
all new metal.
Yeah, so we've done wide bodies, the ones we've announced at Air France, but there will be more to European carriers that are soon to deliver. Again, who knows when the actual date is, but conceptually this year, if everything goes according to plan, and we'll definitely do more wide bodies. I just think there's a balance. So I don't think we're airlines need wide bodies, and not every wide body is made the same, even within the use cases at airlines. So again, like a deep respect for the fleet and route networks that sort of go with it, and a lot of the M&A that we've done in the different sort of different processes to buy airlines outright. I have spent more time with actually what the use cases are for individual airplanes, and so there are some wide bodies that work very well at carriers for part of what they're doing, and some that don't. And so being very precise about where those are going is key to us in supporting them. But we're happy to do wide bodies as well as narrow bodies, but I want to say we're probably 80-20 by value at this point, maybe 75-25.
And shifting gears slightly, right, bringing it into ESG with a particular focus on the E, right, and in playing in those different verticals, you have different perspectives. But your thoughts on the impact that the environmental challenge is having on aviation finance currently, right, and where you think it's going?
The third rail of aviation, the E part of it. Thus far, I think it's very difficult to see any meaningful impact in cost of capital for those that are pursuing environmental strategies. I think pursuing environmental strategies because of more efficient aircraft and turn times and burning less fuel and getting more sort of passengers moved around makes a ton of sense. Like that to me is what I focus on with regards to the capabilities of the aircraft and, burning less CO2 and being more efficient in the way that they run their businesses and operate within airspace, or with turn times and taxiing being more efficient. So anything that's operationally helpful to an airline, I'm all for. Thus far, I haven't really seen any benefit to branding things as environmentally green, et cetera. And I am not one who thinks it's important to cut off your nose to spite your face. I think making these businesses successful and having commerce continue with a focus on being as environmentally efficient as you can is the place to be, as opposed to writ large trying to shut down airports or limit the movement of people or goods or cargo. I don't think long term that helps anybody.
And from your investor perspective, your shareholders, is it a focus on their side, right? On what they are chatting to you about your investments in, or what your potential output on the CO2 side is?
I mean, we've only invested in brand new technology aircraft, and that's because that's where we thought the opportunity would be, as opposed to investors steering us to go do something to check an environmental box. So we've made investments and done leases because we think the airplanes suit the business models, and the business models are enhanced by new technology, Boeing and Airbus aircraft, rather than the other way around. So I think this is not the tail wagging the dog. I think it's the business and use case for the assets that we focus on first and foremost. And it turns out that there's a really good environmental story to go with it, but it's not one leading the other.
And just in closing then, Ryan, as I said, we sit here at the end of October. looking out over the rest of the year and maybe next year and beyond, what are your optimism levels like?
I would say I'm cautious. I don't think I would sit here as being the most optimistic guy, and I don't think I was the most optimistic guy last year when we had our interview. I think healthy caution is important. I am, of course, long-term bullish on the growth of our industry and of travel. I think there are a lot of different challenges that will be worked through over the coming multiple years. So I am not trying to make a sector call of putting lots of money to work because I think everything's going to work and, rising tides lift all boats. Nor am I the pessimist that says everything is going to zero. I think I would say that this is probably a stock pickers environment where picking partners, picking businesses that have competitive advantages and have an ability to nimbly react to those different challenges that we discussed earlier, from cost of capital in the form of interest rates to the inflationary dynamic to the passenger demand to currencies to fuel. A lot of those variables are very difficult, so it's kind of all relative, but I think finding businesses that are suited for long-term success with real fundamental demand in their markets and have competitive advantages relative to the market they operate in are where we're going to continue to look to support and put money to work.
Well, Ryan, thank you as always for your excellent insights. And as you navigate these uncertainties, I wish you and Griffin the very best in the future.
You're very gracious. Thank you for having me.
Thank you.